to go passive.
Right.
But it is a bit of an alchemy that what we're seeing in the markets. Let's take high yield. If you believe the numbers, there's about 9 billion par amount that trades in high yield every day. And if you look at the market value of HYG, which is BlackRock's high yield fund, JNK, which is Barclays high yield fund, that's nearly 40% right there. Is 40% of the market is trading off of the ETF itself. BlackRock likes to talk about the shadow NAV. In other words, what they like to tell people is that there's really never a tracking error with our fund, because whatever price it goes to, the market will eventually follow it there. So it's just leading the market along, and it gives the illusion of liquidity. There are hedge funds now that day trade high yield. How do you day trade high yield? Well, they day trade HYG, and they think that they're day trading high yield. So that market is being, and they're going the next step too. Let's take another set of illiquid markets, frontier markets. It's too hard to buy Nigeria or Gabon. Where the hell is Gabon? Don't worry, just go ahead and play the not the HYG, but the BlackRock Frontier Market ETF. There you go. Now you've got yourself some exposure, and it's tradable, and you can play along with that game. And then they go to the next step. And the next step is that you are allowed to do payment in kind. Payment in kind is standard language in the ETF perspectives that says, if I own some of the ETF, I can exchange it for the underlying assets. And they actually promote that. Don't call up Goldman Sachs and get frustrated trying to buy Gabon or high yield. Buy $100 million of our ETF and call us up, and we'll do an exchange. Now, it'll have to be representative of the index. You don't get to pick and choose the bonds you want, but somewhat representative of the index. You could give us some rules, and as long as we agree upon it, we can do an exchange. So we're giving this liquidity illusion with ETFs that did not exist. Because if you go back and look at the data in 2009-10, where it's 40% of the high yield market, it was less than 2 back then, this kind of trading. So this is new to this cycle.